Investing in stocks can be pretty intimidating if you've never done it before, and many people are afraid to start because of that. They feel like they have no idea what to invest in or what to even look for in a good investment. Unfortunately, this uncertainty often prevents a lot of people from investing altogether, which I think is too bad. I think everyone needs to be investing, and that's why in today's video, we're going to be building the perfect market-beating dividend portfolio with just 10 stocks. Today, I'll be joined by my good friend, the one and only Professor G, and together we'll each share 5 of our favorite dividend paying companies. I guarantee you'll be familiar with most of them. They're all great ones to consider if you're just getting started with investing and are looking for some dividend stocks to add to your portfolio. Before we get to that though, I want to hear from you. Leave me a comment below and let me know which stocks you would put in your perfect portfolio. I'm curious to see which ones you come up with. All right, my friends, we have the man himself, Nolan Gouveia, aka Professor G. My friend, thank you so much for taking the time to do this with me. I really appreciate it.
Yeah, anytime, man. Thanks for the invite.
So you already know the assignment. We are going to be building the perfect dividend portfolio. I've got 5 stocks. You've got 5 great stocks. And I think together we're going to build a really solid portfolio. Now, as our esteemed guest, why don't you kick it off with the first stock in our perfect portfolio?
Sweet. Thank you. What an honor. All right. So I think anybody that's been watching me for any period of time probably knows my favorite stock. So I'm just going to get that one out of the way. And that one's going to be Microsoft. Some people don't think of it as a dividend stock. I definitely do, probably just so that I can justify having so much of it. But Microsoft, obviously the largest company by market cap that we have, solid competitive advantage in multiple ways, most notably AI. The thing that I really like about it is it does have, a 0.70% dividend yield, which isn't crazy, but we have to remember that it's been increasing its share price like crazy. And while doing that, increasing its dividend as well. And so I look for dividend paying stocks that not only increase their dividend, but also the share price is going up. That's just a solid combination there. Microsoft's been consistently growing their dividend at over 10% each year, and the stock price has risen over 223% in the past 5 years, and the dividend still continues to grow.
I love it, man. And for both of those things to happen, the fundamentals of the company have to be growing as well. And Microsoft is just a beast from top to bottom in that department.
Exactly.
So is this next company, actually. This is going to bring us to stock number 2. This is one of my favorite stocks. I actually think this is like the gold standard of stocks. We're talking about Visa, guys. And Visa is the largest payment network in the world. They're bigger than competitors like MasterCard, Amex, Discover, and Visa processes something like 65,000 transactions every second, which is just insane. And they collect a fee on every single one of those transactions, which, as I'm sure you can imagine, adds up to be just an insane amount of money. And because of that, Visa is just a free cash flow printing machine. If we look at their free cash flow chart, actually, we can have it. Well, I'll put it up on the screen right now. It just goes up and to the right. Okay, and I think that trend will keep going as people continue to move away from paying for things with cash and instead opt for probably more efficient payment methods. And this is only going to stand to benefit the dividend, which if we take a look at the dividend stats, somewhat similar to Microsoft in nature, like we have a really low starting yield at 0.75%. But look at that 5-year growth rate. It's off the charts at 16%. So you're benefiting from very substantial dividend growth. And Visa's been growing the dividend ever since they went public. I think it was in 2009. But anyway, they have a 15-year dividend growth streak there. So that is my first pick. Why don't we kick it back to you, man?
Oh man, Visa. It's gonna be hard to follow that. That's a solid. I love the dividend growth on that, and I love the dividend growth on this next one. And this next one is going to be kind of on the other side. So I started with some technology. This one's going to be a little bit more of like a boring stock that people kind of look over. But to me, this is huge, especially in dividends and something that you're looking for in a sustainable stock. And for me, that's Home Depot. I just love the business model, right? You have Lowe's, who really goes after the DIY consumer, the person that's going to be really fixing up their own home specifically, where Home Depot has that, but they also really, really target the professionals, right? The plumbers, the electricians, the people doing much bigger jobs. And it's very, very smart in that regard. But the median age of a home in the US is 40 years. And so people are going to be needing to continue to fix up their home. And Home Depot is one of the ones that, one of the only places people are going to go to get those types of things. Most years, the dividend growth for Home Depot is insane. The average CAGR is well above 10% and sometimes up close to 20%, which is unheard of. It's grown its dividend for about 20 years straight. Right now it has a 2.71% dividend yield, and the stock's barely down a little bit this year, which is a nice little sale for someone to pick this one up.
I love it. A lot of people think of Home Depot and Lowe's as being in this sort of duopoly, which for the most part they are. But interestingly enough, Home Depot's sales, I actually didn't learn this until recently. Home Depot's sales are like milestones ahead of Lowe's. They just bring in so much more revenue than Lowe's, which is going to be their closest competitor. And like you said, Home Depot really shines by catering to the contractors, catering to the pros. As Home Depot says, I think their messaging is like, we're for the doers. Have you heard that?
Yep.
So yeah, Home Depot is definitely a hard one to beat. My next company, so this is going to bring us to stock number 4, is also going to be a relatively boring one. Another one of my favorite companies. This is one of the largest holdings in my portfolio, actually. This is Procter and Gamble. And in my opinion, Procter and Gamble puts the staple in consumer staples. And the reason I say that is because they make things that people are going to need to buy no matter what. We're talking toothpaste, laundry detergent, deodorant, diapers, paper towels, toilet paper, and so many more things. And all of their brands really are the cream of the crop. They're going to be the most notable names in these spaces: Crest toothpaste, Tide laundry detergent, Old Spice. And I mean, I have them up on the screen right now. The list just goes on and on. And in terms of the dividend, just kind of adding to that reliability, that dependability, Procter & Gamble is a champion. They are a dividend king with a 67-year dividend growth streak. They've been growing their dividend more than twice as long as I've been alive, at least. And the rest of the stats are pretty moderate. We have a 2.4% yield and a near 6% 5-year dividend growth rate. But you take those two things, compound them across a long period of time, and you'll be sitting pretty with Procter & Gamble.
Can't really beat that one on anybody's list that I've seen. If they leave off Procter & Gamble, I don't know what they're doing. So good choice there.
They have a screw loose for sure.
That's true. That's true. All right. Well, this next one is one that I've had a lot of conversations about. I really like this one. I really like the idea of this. So nowadays, everybody's talking about electric vehicles, or they're talking about just electricity in general, or different forms of energy, right? And they're on the right track. We are going to be going that way 10 years, 15 years. But right now, we still need gas. We still need oil. And so this company here, this is Chevron. And for me personally, I look to Warren Buffett just to see, what is he doing? Because he's obviously been doing some things right for some time. And he has talked about the fact that he has such a heavy reliance on oil because it's not gone yet. And if we think about it, yes, there's a lot of eggs in the basket of electric vehicles, talking about Tesla, talking about electric driving. But if we think about other things that take gasoline, things like huge cruise liners or rockets, we talk about what kind of battery are we going to need to power something like that? I don't know if that's even feasible. And so gas specifically is something that we need now. We're going to need in the future still. So yes, it's good to look into the future for this electricity type energy, but I'm still looking at one of the oil giants, which would be Chevron. The current dividend yield is a little over 4%. The stock's up almost 5% year to date, almost 30% on the 5-year chart. So like I said at the beginning, I'm looking for dividend stocks that have a sustainable dividend that keeps growing, but also the share price is growing along with it. So for all those reasons, I'm in on Chevron.
Yeah. And as far as the whole transition from fossil fuels to, I guess, renewable sources, it's going to be a very slow change. And if you think about like the lithium batteries that power Tesla cars and all the EVs and stuff like that, the equipment that people use to drill that stuff, that's not renewable, powered by renewable sources. That's powered by fossil fuels still. So there's just so much in our infrastructure that's powered by that. And like I said, it's going to be a really very slow, multi-decade probably transition. So at least in the meantime, in the interim, companies like Chevron, like Exxon are still pretty safe bets. And in the meantime, like they're just printing cash.
Exactly.
So that's going to bring us to number 6, stock number 6. My pick for this one is going to be Vici Properties. Now, for someone who's just getting into investing, you maybe have not heard of this company before, but you'll certainly be familiar with what they do. Vici Properties is a real estate investment trust that owns a lot of the hotel buildings on the Las Vegas Strip. They own the Caesars Palace building, Excalibur, Mandalay Bay, MGM Grand, the Luxor, New York, the Venetian, and the Mirage, which actually is about to close and become the Hard Rock next month, which is kind of sad. But anyway, long story short, Vici Properties owns what is definitely one of a kind real estate. You will not find properties like this anywhere else in the world. In my opinion, there is no, and I live here in Vegas, there is no other place in the world quite like Las Vegas. I'm extremely bullish on the city. But anyway, because of the type of real estate Vici owns, one thing to note about this company, which could be a potential risk, is that almost 75% of their revenue comes from two tenants. And those are going to be the casino operators here in Vegas, Caesars Entertainment and MGM Grand. Those are the companies that occupy and run these buildings. And having that much revenue concentration from such a small amount of tenants could potentially be detrimental to Vici if something were to happen to either of those businesses. But still, with that, I think the chances of that happening are pretty slim. But, you know, it's a crazy world, and I guess anything's possible. And with that said, it does beg the question, you know, what if there's a downturn? What if we go through some environment where people are not traveling to Las Vegas as much? We actually experienced that a few years ago, knee deep in the pandemic. I actually came to Vegas July 2020, right in the thick of things. And I remember it being a complete ghost town. We were pretty much the only people in Vegas at the time. And what's interesting about Vici Properties during this time period, you'd think that they would have trouble, or their tenants rather would have trouble paying their rent because nobody was coming. Nobody was spending money here on rooms, on gambling, on dining and entertainment. Interestingly enough, during this period, Vici actually collected 100% of their rent. And they have collected 100% of their rent ever since being formed back into 2017. So with that, looking at the dividend stats, Vici Properties is double trouble in the dividend department. They have a near 6% dividend yield. So your starting yield is going to be really high. A lot of immediate cash flow coming from this company. And you also have a pretty respectable 5-year growth rate is 7.75%. And they've been growing this dividend for the last 5 years. So that streak is well and alive, but like I said, this company was first formed in 2017, so they don't have an extensive track record yet of paying the dividend. But I'd be surprised if this streak didn't continue. So overall, I think there's a lot to like about Vici Properties. And actually, while we're on the subject of Vegas, I'm doing a little staycation on the Strip tonight, which will be a lot of fun. So, but anyway, that's neither here nor there. Yeah, it'll be fun. Anyway.
Awesome. It only takes me a couple hours to get out there, so maybe I need to come see you for staycation, bro.
I know. Well, last time you were out here, we didn't get to hit the Strip, so
I know.
Yeah, that'd be fun.
Yeah, definitely. All right. Well, yeah, I mean, as far as REITs are concerned, that's one of my favorites as well. So good pick. I just think in general, right now, REITs are hit pretty hard, obviously, because of the mortgage rates and just rates in general being so high. Real estate is not as favorable and it's tough. But I just know that once the Fed takes down those rates over the next couple of years, we're going to see a big increase in those REITs specifically. And the fact that they've kept their dividend that high during this, downturn is pretty favorable in my opinion. So nice pick. All right. So my next one comes from the healthcare sector. I was looking through, when you asked me to look at a couple of different dividend stocks, what I definitely wanted to do was to diversify. Obviously, a lot of the stocks that I like are going to be in technology and, things like that. But healthcare is just one that, it's not going away anytime soon. We're going to need it. Everybody needs this sector. And in this sector is one specifically that I really like, and this is AbbVie, ABBV. So taking into account the time it's spent as a division of Abbott Laboratories, AbbVie's a dividend king that's now raised its payouts for 52 consecutive years. Has a current dividend yield of 3.7%. The thing is that, AbbVie came under fire just a little bit because it lost a little bit of its steam because its main drug, Humira, they lost the patent to that, or the exclusivity patent to that. And so that just means that other companies can make a generic version of it. And, that hurts a company when that was their all-star. But even with that, AbbVie's grown over 20% in the past year. Something that's pretty interesting that just happened last month, May 13th, AbbVie signed a deal with the biotech Gilgamesh Pharmaceuticals to collaborate on the research and development of novel therapies for psychiatry. So they may be able to get all the positive effects of psychedelic drugs, but without the hallucinations. So right now, obviously that's a big topic of interest right now with, mushrooms and just the idea of healing people more in a healthy way without having to use harsh medicines. And so if they can really harness the good that you can get from this more natural way of healing people without hitting the bad side effects, and they can get, some type of a patent on that, they're really going to curb the market on that for sure.
100%. We've been, well, Peanut's been microdosing for the last few months, and he's been seeing some really good results from that. So it'd be cool if AbbVie can get in that game. Yeah, absolutely. No, great pick, man. AbbVie's been a beast ever since coming out of Abbott. They've been a really, really solid company. I have a small position in AbbVie, and it's done pretty well for me so far. So
great.
Really good pick. So now we are at number 7.
I think you're on 8 because I started, so I'm odd.
Oh, okay. At any rate, moving on to the next one, guys. This one's also a little bit under the radar. There's a chance you may not have heard of this company, but it's actually a pretty important one. This one is going to be American States Water, which is a water utility company that operates out of California. Now, they provide water distribution services and wastewater collection services mainly throughout the state, where they service over 80 different communities. But what's really cool is that along with that, they also have government contracts in place to provide these services to over a dozen military bases throughout the country. And most of these contracts are locked in for 50 years. So a very long time. And that's fantastic. I mean, as I'm sure you know, water is one of the most essential resources out there. So they have a lock on that. And American States Water is a dividend king, guys. The dividend stats in the 5-year growth rate are very respectable starting there. 2.4% yield, 9.35% 5-year CAGR. So classic dividend growth stats. And look at that dividend growth history, 68 straight years. American States Water is definitely one of those sleep well at night, one of those swan dividend stocks that I think are a great addition to any investor's portfolio. It's kind of it's actually a very boring company, but the dividend growth on this one is certainly not boring, nor is the dividend growth history. So all across the board, I think American States Water is a really great one to consider.
Yeah, definitely. Again, a staple in a lot of dividend investing portfolios, very sustainable. The last one, at least from my end, is still going to be in that technology sector, because for me, I'm looking at trends. Obviously I'm geeking out as a professor, and I'm looking at what are people talking about, what are people caring about, but also what are, almost every company in their earnings reports, they're definitely saying a couple buzzwords, a couple of key things that investors want to hear. And everything is centered around AI, everything. And so in order to power AI, we need microchips. And obviously, everybody's talking about NVIDIA and Taiwan Semiconductor, but there's one that's kind of a sleeper in this category. And for me, that's Broadcom. And that one is a very solid dividend. It's sneaky too. It's a sneaky little dividend play because it's been growing its dividend for over 13 years. Has a nice little dividend at 1.46%. For some people, that seems low, but if you look at the share price, that's definitely not a low amount of money. And the fact, again, just like I've been saying from the beginning, I look for companies that not only grow in their dividend and are just, purely sustainable, but also the share price is growing alongside with it. And if, the dividend's growing and the share price is growing, that's a great thing. The stock itself has grown over 441% in 5 years and still grows that dividend with it. A big stat that I saw is that AI could reach 25% of semiconductor industry revenue by 2027 versus 5% in 2022. So Broadcom can take part of that market share from NVIDIA and TSM as a good alternative for the market. A lot of people, understandably believe that NVIDIA is going to be the leader, and I do believe that as well. They have some pretty solid moats there. But just because there's a leader doesn't mean that nobody else gets market share. And Broadcom is definitely in the running, and it's one of the ones that's not as overvalued as something like an NVIDIA.
I love it, man. I read a stat recently that said, and I'm paraphrasing, but it was something like Broadcom touches over 99% of the internet. Like I said, I'm paraphrasing, but essentially, if you're using the internet at some point or another, you're dealing with Broadcom chips.
Right. Broadcom might be one of the most underrated companies when it comes to anything that we consider technology.
But anyway, guys, that was stock number 9. This is going to bring us to our 10th and final stock. Another one that's definitely under the radar, but this one is a behemoth. This is Old Dominion Freight Line, which is one of the country's leading trucking companies. And fun fact, in 2023, trucking was responsible for moving about 13.1 billion tons of goods across the country, which accounts for a whopping 64.7% of all transported goods by weight. So trucking is a pretty critical industry, and companies like Old Dominion provide a service that is very much in need. Now, one important thing to note about Old Dominion is that they specialize in what's called less than truckload or LTL operations, which typically pick up multiple shipments from multiple customers on a single truck, as opposed to truckload shippers, which generally dedicate an entire truck to one customer from point A to point B, from pickup to delivery. Now, this LTL structure for Old Dominion seems to be working pretty well. And across the last 12 years, or actually, excuse me, across the last 22 years, this company has seen a pretty aggressive revenue growth rate of 12% on average in this time period. That's just insane. And the dividend stats are looking great as well. I think this is going to be our lowest yielding stock of the day, interestingly enough, at 0.6%, which is admittedly not anything crazy to write home about, but the rest of these stats are looking great. The payout ratio, extremely low, one of the lowest out there at 15.2%. So that dividend is well covered by this company's earnings, and the 5-year growth rate is off the charts. This is one of the highest 5-year CAGRs I've ever seen at near 36%. And they've been growing this dividend for the last 6 straight years.
That's great. That 5-year CAGR is off the chart.
I know, man. It has my mouth watering for sure. But anyway, man, those are our 10 stocks. I think we picked really 10 solid companies. Not only are the companies themselves really solid, but a very wide and diverse batch of companies. I think we hit pretty much every sector with those 10 right there, which is awesome. We didn't even plan to do that necessarily. It just kind of happened.
I'm interested to see how it holds up.
Oh, it's going to be good. And actually, we're going to jump over to that right now and take a look at how this portfolio has performed. But before we do, my man, thank you so much for doing this with me once again. I really appreciate you taking the time, and it was a lot of fun.
Thanks for the invite. Yes, sir. See you soon.
Anytime, man. All right. See you soon. So anyway, guys, now that we have our 10 stocks, this is what it looks like if we put them all together in a portfolio. We can see that if we accounted for an equal distribution of all these 10 stocks, just 10% into each one, the dividend stats are looking pretty good. We're coming in with a nice 2.5% yield, so that's pretty moderate, and a really killer 5-year dividend growth rate across the portfolio of near 13%. So this is going to be your classic dividend growth portfolio. And overall, I think this portfolio is looking really great. It's very well diversified across different sectors. You know, we got technology, healthcare, utilities, energy, consumer discretionary, industrials, staples, financials, and real estate. And like I said earlier, this portfolio of stocks has historically generated market-beating returns. And if you would have invested in this portfolio, you know, just these 10 stocks over the last handful of years, you would have actually outperformed the S&P 500. Now, initially, I wanted to do a 10-year back test here, but Vici Properties is screwing that up for us, guys. Vici was formed in 2017, so the portfolio visualizer only has data from the start of 2018 until today. But nonetheless, in this 6.5-year time frame, if you would have invested $1,000 both into our perfect portfolio and $1,000 into the S&P 500, and then invested $100 every single week into both, today you'd have almost $57,000 in the perfect dividend portfolio compared to just over $50,000 in the S&P 500. And if we compare the annualized returns between the two here, we can see that with our perfect portfolio, the annualized returns would have been about 18.5% in the 6.5-year time period compared to about 13% with the S&P. So that's all looking really good. But still, I'd really like to see what a 10-year time frame would have looked like investing in this portfolio. And so I know it's not going to be perfect, but we're going to run this same back test again, minus Vici Properties. So we're just going to do the other 9 stocks without Vici. And with that same setup, minus Vici Properties, looking at the 10-year period, starting with $1,000 in both, in our perfect portfolio, you'd have about $136,000 compared to almost $92,000 with the S&P. So that's quite a big spread between these two. Across these last 10 years, our perfect portfolio would have generated an average return of almost 21%, 20.87% to be exact, which is just crazy, compared to the S&P's 12.5%. So once again, quite a big spread between these two. But anyway, what we just looked at was the past until now, and it's important to keep in mind that those returns may not carry over into the future. We have no idea what's going to happen moving forward. But still, I think it'd be fun to take a look and see what this portfolio might look like, 20 or 30 years down the road if you invested in it today. And to do this, guys, guys, we are going to be using the Dividend Reinvestment Calculator tool over on dividendreinvestmentcalculator.com. And this is a new portfolio projection calculator that I started using recently. If you guys are familiar with my videos, you'll know that I usually use the marketbeat.com dividend calculator, but I really like this one. And if you guys want to check it out, I'll link to it in the description of the video. But anyway, guys, in our projection here, we're going to start with an initial investment of $1,000. And every single week, we are going to be investing $100 into this portfolio across the next 30 years. And here are some of the other inputs as well. We're going to use our dividend portfolio starting yield of 2.48%. And while our portfolio had a 5-year dividend growth rate of near 13%, we're going to be a bit more conservative and say that moving forward across these next 30 years or so, the dividend growth rate is going to average out to about 10%. And we're also going to use an 8% share price appreciation in this calculation. But anyway, looking at that, guys, after 20 years in this portfolio, you will have about $353,500 just from investing $100 every single week, which I think is pretty crazy. And in your 20th year, you would have received $10,607 in dividends, which is not too shabby considering you pretty much started from scratch and then from there only invested $100 per week. But anyway, if we go 10 more years into the future, your $353,000 portfolio will grow into almost $1.2 million, which is insane. This is the power of compounding right there, guys. And that is such a big jump in only 10 years. And looking at things on the dividend side, your dividend income in this time period pretty much quadruples and goes from just about $10,000 to over $42,000. So once again, this is the power of compound interest and the dividend snowball effect. Now, guys, as I was kind of saying throughout the video, I actually have quite a handful of the stocks that we talked about today in my own portfolio. I have AbbVie, Chevron, Proctor and Gamble, and Visa. And in this next video right over here, I'm going to show you my position in these companies along with the rest of my dividend stock portfolio. We'll get into every single one of my holdings, including the number of shares, and also show you the gain and loss with each position. So click right over here to check that out, and I'll see you in the next one.